Uh, Let me thank you for inviting me to be amongst you this morning. It is a good initiative of CAFRAL in organizing this program on governance of directors of banks for the NBFCs. The importance of governance and the role of boards in NBFCs has never been more critical than it is today. In my address, I want to focus on several emerging issues which requires the boards to take notice and act. Later, I would like to also articulate our expectations from the board functionaries. Now, trust is and has been the cornerstone in the business of finance. While all the legal and regulatory frameworks are aimed at supporting and reinforcing this trust, it needs to be nurtured through good governance practices and ethical behavior from the people at the helm of these financial institutions. As I have emphasized recently somewhere else, business conduct and governance in financial services are the key soft pillars which build the edifice of a successful financial institution. Motherhood statements regarding corporate governance abound in the system and at conferences. Translating them into practice in a boardroom is what tests our professionalism. In particular, there is a need to reflect on the role and expectations from the governance architecture, that is the board and its committees, the independent directors, and the assurance functions in the financial institutions. The financial industry is witnessing a reversal of the trend of sorts, much like the fashion industry, where old styles and colors are often woven into new fabrics. In the 1940s and 50s, some of you may recall, several textile mills around Coimbatore used to finance their fixed assets by accepting public deposits and paying interest on such deposits. As proliferation of traditional banking was almost non-existent, individuals had no other avenue to keep their savings and earn interest on them. These mills were in business of finance, even though their core activity was completely different. A distinctly similar trend is emerging now. More and more entities unrelated to financial business are wandering through the alleys of finance, suited up in the shining fabric of digital innovations and hybrid products. Given that unlike the 50s, in the current era, the business of finance is tightly regulated, almost all of them seek to piggyback on the balance sheet of one or the other regulated entity. Keeping this development as a background context, let me highlight the role of the board of an NBFC in this era of disruption through digital innovations and the blurring of boundaries between a financial company and a non-financial entity. Now, the first point which I thought I would focus on is that the less regulatory prescriptions may actually imply a greater role for the board. The NBFCs are typically subject to less rigorous regulatory regime as compared to banks. We may have brought in a greater degree of regulation for NBFCs under the new scale-based regulation. Yet, the extent of regulatory prescriptions for the NBFC sector is far less than those for banks. I'm not just referring to the aspects of prudential regulation and business conduct. Even in the realm of corporate governance, NBFCs face a far milder set of prescriptions from the regulator. This sets up two very important perspectives. First, the role of the board is far greater for a regulated entity when the regulatory prescriptions are minimal. Under such circumstances, the board has a far greater responsibility to put in place appropriate strategies and steer the entity on the path of genuine and fair business practices. The explicit regulatory dependence on the board's responsible functioning can also be seen in the latest scale-based regulation. This is an aspect I propose to touch upon a bit later. Second, the principle of proportionality in regulation, which I have been emphasizing in reserve banks dealing with regulated entities, must be allowed to play out. From a systemic risk point of view, NBFCs do not need to be brought under a very rigorous regulation other than where adverse regulatory arbitrage gets built up through newer processes and practices. Being non-deposit taking, notwithstanding a few deposit entities being there in the system, NBFCs depend primarily on markets for funding, and the market mechanism is expected to discipline them. Yet, there are certain areas of NBFC functioning, say customer protection and market conduct, where market mechanisms may not be enough and public policy requirements should override private motivation. In such areas, regulations will play a greater role. Here, the boards are expected to be guided by objectives that transcend mere profit and growth. The regulatory prescriptions may be less for NBFCs, but the spirit of corporate governance is no less significant while meeting regulatory stipulations. The word governance can be an omnibus adjunct to most activities being carried out by an entity. While it is generally accepted that good corporate governance is one of the major factors contributing to improved financials and growth, the vice versa is not necessarily true. Good corporate governance often manifests through certain identifiable praxis, that is, positive corporate behavior, reduced cost of capital, improved decision making, better strategic planning, more effective internal controls, better visibility of and response to errors, competitive advantage gains, and greater abilities in attracting and retaining talent. Some of the common factors that tend to reduce good governance to poor governance include differing economic incentives, greed, asymmetry of many kinds, and lack of timely and correct feedback. Corporate governance is not just about decorating annual reports with regulator-mandated certificates and disclosures just to meet regulatory prescriptions. Now the question which then comes about is, why not leave corporate governance just to the provisions of Companies Act? As companies, NBFCs are required to conform to the principles of corporate governance as enshrined in the Companies Act. Certain layers of regulatory prescriptions on corporate governance for NBFCs over and above the statutory requirements are only supplemental. For instance, we have asked large NBFCs to appoint a chief risk officer and have also prescribed the attributes of a chief risk officer. Moreover, the formats have been prescribed by RBI through which the directors of systemically important NBFCs as well as deposit-taking NBFCs are required to provide periodic information to the nomination committee for fit and proper assessment. This is also the prescription of setting up, there is also a prescription of setting up a risk management committee. These stipulations, over and above the statutory prescriptions, serve specified purpose, and the directors need to appreciate as to why these have been prescribed. The Companies Act provides the minimum requirements for an NBFC to comply as it's incorporated as a company. However, as a financial sector entity, it is important to the adjunct to the financial system in the financial sector, and its actions have a bearing on financial stability. It is therefore has a lot more to do in terms of strong corporate governance. In the absence of specific regulatory rules, the board must explore aspirational objectives to achieve excellence in corporate governance practices. A good board should be able to satisfy itself that it has adopted better practices than the minimum required. Good corporate governance is not limited to the blind following of prescribed rituals. It's also about adherence to the spirit and not just the letter of the guidelines. Let me elaborate a bit more on this. First issue is engagement of the board. An engaged board spends time in actively engaging in dialogue that explores larger and material subjects in terms of framing important issues, asking the relevant questions, and considering alternate options. Critical and creative thinking are part of this process. Many a times, long-winded board meetings end up with a lot of information, presentations, and analysis without much value addition for the decision being taken or required to be taken. But again, we should be mindful of going to the other extreme where boards excessively challenge the management. Engagement is not about micromanagement, but about getting specific information regarding the tasks and responsibilities with adequate commitment of time on part of the directors. A second challenge is short-termism. John Maynard Keynes famously said, in the long run, we are all dead. But financial institutions are different from us mortals and are structured to exist over a long period of time, provided, of course, they are nurtured appropriately. This needs development of an appropriate long-term perspective. While individuals may tend to crave for growth all the time, the euphoria of growth can sometimes be orchestrated, illusory, or brittle in terms of sustainability with focus on quick short-term results. When boards feel pressure to deliver quick results in the short term, This can lead to a focus on short-term financials at the expense of long-term stewardship. A culture that values delivering growth at any cost is usually accompanied by potential underinvestment in key areas, injudicious squeezing of costs, or predatory price and margin behaviors with long-term negative consequences. Strong financial results, though attractive to investors, is not necessarily the same as high-quality sustained performance. Financials can often be a lagging indicator masking performance problems which may manifest in the long run. Good performance should be analyzed just as thoughtfully as weak performance to weed out short-termism. Conduct of business is a third important aspect. It's equally important for management to not only deliver good performance, but to do so by resorting to acceptable customer and market conduct. Unfortunately, this is one area where we have seen the least amount of engagement from the boards, especially in those of NBFCs. The board should accept responsibility for corporate conduct, including all acts of commission and omissions under their stewardship. There is a need to engage on all aspects of corporate functioning at the board level. This means the need to eschew mental compartmentalization of contributing just to your specific domains of expertise at the board deliberations, say technology, HR, or regulations alone, and not actively engaging in deliberations in other domains. It is important to have perspective on all matters passing through the board or a committee, and one should be aware of business practices being adopted by the entity to achieve the financial results. Finally, I would also focus on a whistleblowing mechanism. Giving whistleblowers in their rightful place in a corporate governance mechanism has been talked about far more often and delivered far less on the ground. I don't want to cite examples from recent experiences. All I would like to emphasize here is that such matters are best handled in the right spirit within the Craven framework. This would leave less scope for external authorities to intervene, which tends to reflect adversely on the standards of governance in a board. Now, let us come to the issue of scale-based regulation, which I alluded to earlier. Is it a harbinger of stiffer regulation for NBFCs? Not exactly, as I would say, as I stated before. Scale-based regulation is based on the principle of proportionality. However, there are certain principles for board functioning that are size neutral. For example, the requirement that the board members should be fit and proper. At least a few board members should have adequate experience and education to handle the nuances of financial business, that the board should determine the overall risk appetite and exercise adequate control to ensure that the same are adhered to. NBFCs in the middle and upper layers need to comply with greater governance regulations. To give some examples, one, except for the directorships in a subsidiary, the key managerial personnel shall not hold any office, including directorships in any other NBFC in the middle or upper layer. A timeline of 2 years is being provided with effect from October 1, 2022 to ensure compliance. They can, of course, assume directorships in NBFCs in the base level. Within the permissible limits in terms of Companies Act, an independent director shall not be on the board of more than 3 NBFCs in the middle level or the upper level at the same time. These NBFCs should ensure that there is no conflict arising from the independent directors being on board of another NBFC at the same time. There is no restriction to directorships on the board of NBFCs in the base level, subject to applicable provisions of the Companies Act. NBFCs will also be subject to compensation guidelines proposed to be issued by the Reserve Bank of India. There are disclosure requirements covering composition and category of directors, shareholding of non-executive directors, modified opinion, if any, expressed by the auditors, its impact on the various financial items, and views of the management on audit qualifications. Items of income and expenditure of exceptional nature, breaches in terms of covenants in respect of loans availed of by the NBFC or the debt securities issued by the NBFC, including incidences of default, divergence in asset classification and provisioning above a certain threshold. What needs to be appreciated here is that these regulatory prescriptions are the barest minimum intended to create a healthy environment for the business operations of the NBFCs. The two aspects that I would specifically highlight here are that one, NBFCs in the upper and middle level are required to formulate a whistleblower mechanism for directors and employees to report genuine concerns. And two, the board shall ensure good corporate governance practices in the subsidiaries of NBFC. The whistleblower mechanism would set up a system of checks and balances and would empower every person in a constructive manner. Good governance is, after all, a collective outcome which needs contributions at all levels. The other stipulation would ensure that the subsidiary route is not misused by the NBFCs to carry out activities that they are shy of doing as a regulated entity. The scale-based regulation has placed several responsibilities on the board, which the Reserve Bank as a regulator could have directly prescribed. With this, the role of the board is far greater under the scale-based regulation, especially for NBFCs in the middle and upper layers. Just to elaborate on this, one, the board is expected to oversee the internal capital adequacy process, or the ICAP. This is a significant development, and I would urge the directors on the board of NBFCs to understand its importance. The board is now required to make a realistic assessment of risks from all sources as per the methodology to be determined internally and ensure that adequate capital is available to support all risks. This is a huge responsibility for the board to have its own bespoke methodology for assessment, monitoring, and mitigating the risks. The ICAP would document the entire process, providing a formal structure to abide by. We expect that the process would stimulate better risk management practices with the active involvement of the board. Second, the board is required to lay down its own policy on sensitive sector exposures and even decide internal exposure ceilings. Further, it is expected that the board would carry out vulnerability assessments to determine such ceilings. This stipulation would prompt boards to deploy scientific methods and determine the entity's risk appetite. If the NBFC belongs to the upper layer, it should even prescribe exposure limits for other significant sectors, including exposure on other NBFCs. While restrictions are envisaged regarding loans to directors, senior officers, and relatives of directors of NBFCs in the middle and upper layers, the board of NBFCs in the base layer are expected to implement the spirit of regulations through their board-approved policies. To sum up, the scale-based regulation has, in fact, focused on empowerment of the boards of NBFCs. It is not that the scale-based regulation has prescribed more regulations and reduced the NBFC's freedom to operate. On the contrary, the regulations have merely defined important areas of operation where the boards need to do more. What is envisaged at the heart of the regulatory framework is an active, alert, and responsible board for all NBFCs. Now, let's come to the issue of digital lending, which is a growing challenge as far as the financial sector is concerned. Now, digital lending is the new game in town, which has thrown open newer challenges. The boards need to guard against any activity carried out in violation of the extant regulations, as the general principle is what cannot be done offline cannot be allowed to be done online. The boards must understand the risks by asking the right questions. What the general risks in any activity in digital lending are. Is the risk shared with any other entity? What is the basis for pricing the services? What are the outsourcing arrangements? And above all, what are the regulations and statutes governing such activities? If the NBFC is operating in an area where regulations are either absent or unclear, the board must decide its path with utmost circumspection. Above all, the NBFC should not allow their balance sheets to become rented vehicles for other entities, and each tie-up should be carefully evaluated not only from the business angle, but also from conduct and customer service safeguards being suggested by the management. The entities need to be mindful of the fact that ultimately the responsibility for ensuring protection of customers lies with the NBFC, and in case of any misadventure, it is the NBFC who would be subject to regulatory strictures and perhaps even legal actions, I think, as we have seen in the recent times. Many of the episodes which exploded in the non-banking system since 2018 were simmering for extended lengths of time and at times hiding like an elephant in the room, even as batches of directors, both executive and non-executives, passed by. While it would be wrong to say that the smoke signals were non-existent or were not picked up, the expected levels of governance was perceptibly absent, necessitating a hard stop by the supervisors for putting an end to the tenuous thread of false narratives of assurances and financial creativity. To put it succinctly, it's unfair to expect the regulators or supervisors to guard an entity at every stage. Further, any overriding regulatory and supervisory action, however small, needs to be viewed seriously as a commentary on the board of a bank. Let me conclude by stating the obvious, that the role of corporate governance is extremely relevant for non-banking financial entities. To develop a balanced approach, the directors should be constantly looking for the smoke under the door, no matter how faint the signals could be, and finally take a truly independent view of their responsibilities. Having said that, I acknowledge that there are many positive stories and good examples of good corporate governance standards. Board members with skills that include authority, resolve, leadership, and persuasion have been able to make a difference. I do hope that some of these pointers would help to shape a meaningful set of deliberations during the course of this conference. Wishing you all the best. Thank you. Stay safe.